What's going on, everyone? This is going to be a quick video explaining why I want the market to open up very, very red and why we're going to day trade calls. All right, so this is going to be my trade plan, and I'm going to give you guys a little history of why this works out so well. So essentially, right now, we can see that the SPY is trading outside the lower level of the Bollinger Band, right? Now, if we open outside the lower level of the Bollinger Band, I'm going to give you guys a quick glimpse into history. All right. So what we're going to do is we're going to watch a replay of this most recent downturn. All right. And we're going to track the days that we opened outside of the lower level of the Bollinger Band and what would happen if you were to start scaling into calls at the open of that day. All right. So this is going to make more sense. So right now, cool. This is the SPX. We're going to go look at the chart for the SPY during this downturn. All right. So this is, we're at January 14th right now. I have a replay and we're going to go and look at which dates the SPY opened outside of the lower level of the Bollinger Band. And for quick context, if you were to buy outside of the lower level of the Bollinger Band at basically any point for the past 2 years, we always revert back into the mean. And it's been a surefire trade every single time. But this is going to be a day trade. We're not going to be swinging anything. All right. So this is basically my reasoning. All right. So this is January 14th. So now what we have to monitor is the lower level of the Bollinger Band right here at the 459. Right. You see this number? That is going to be the lower decimal or whatever, the lower level of the Bollinger Band. All right. So January 14th. Let's press play. Cool. So right now, all right, that's kind of fast. All right. Oh, all right. So look. So right now, when I hover over this, you can see that the lower level of the Bollinger Band right here is 455.17. Okay. So now January 19th, we closed outside of the lower level of the Bollinger Band. Now, to have an open outside of this level, we would have to open lower than 455.17. Okay, does that make sense? Go ahead and make this bigger. So for my thesis to work, we need to open lower than 455.17, and then I would start scaling into calls. All right, so let's look at what happens the next day. All right. So remember, it was 455.17. Today, on this day over here, January 20th, we opened right here at 453.75. So what I was saying is if we open outside of the lower B band, it's a great time to scale into calls. All right, so now let's look at the 5-minute chart for January 20th. We can see this is one clear example of us opening outside the lower B band. All right. Now let's go to January 20th. Alrighty. January 20th. Look at what happened. So we obviously opened outside the lower B band. And here's the open. Cool. Obviously, you know, so we opened at whatever, 453, whatever, and we bounced all the way up to 458. Cool. That's just one example, though. That doesn't mean anything. Cool. Obviously, we need more data points. Next. Oh, sorry. So now you can see the lower B band is now at 451.43. So now we need an open below 451.43 once more. 451.43. Okay. So today we opened. Oh my God, stop. All right. So over here, we opened at 445.56. So that's obviously lower than 451.43. All right. So now let's look at the chart for January 21st, the 5-minute chart. So obviously, this is just a day trade for January 20th. But okay, so now let's go to January 21st. So look, this is why I'm saying it's going to be very, very risky. And that's why trade management for tomorrow is going to be very, very important. So we opened up here, right? We open up with a green candle. If you were to buy one contract, most likely tomorrow I'm going to alert $200 or $300 contracts expiring about 2 weeks out. So if you were to buy one contract here, automatically you would have lost a lot of, I mean, you'd probably be down about like 20% at this point, right? Now, if you were to buy another contract here, as it fell to 443, and just keep in mind, January 21st, we opened outside the lower level of the Bollinger Band again. So this is another example of a bounce play that we're going to play, okay? So, cool, you bought one at the open, $200-$300 contract. Within 20 minutes, you'd be down 20 or 30%. Now, say, for example, you want to buy another one. The initial contract, and we fall even lower. The initial contract is going to be down about 50%. These contracts are going to be down about 20, 30% as well. And then as we fall down very, very heavily, even more, you have to realize that when we gap down and open outside of the lower level of the Bollinger Band, the lower we fall, the better it is for a aggressive bounce, because people have loaded up on so many puts that it is the perfect opportunity to make a lot of people lose money. Okay, so now you buy $200 worth here, you buy whatever $200 worth, you buy another contract here, and then if we fall down and make a third very heavy leg, basically you're scaling in as we continue falling lower. All right, so you're buying your cheapest at the open. So what we're going to do is we're going to buy the cheapest amount at the open. And then essentially every single time we make a lower, so you'd buy 200 here, you'd buy 400 here, and then you'd buy a bunch more down here. And essentially it's going to be according to your risk. All right. Ideally, if you just wanted to buy one contract, say you just wanted to risk $500 tomorrow. What you're going to essentially have to do is you're going to buy one contract at the open, and then you're going to go ahead and buy another contract on a huge drop downwards. And then from there, you're just going to wait, I guess, because you don't want to risk any more money. But mathematically, we do bounce back. So for larger accounts, if you want to risk $1,000, you'd scale down 200 at the open, you'd buy some more on a huge leg downwards, and then you'd load up the rest of your $1,000, or whatever you have left down here at the bottom. You've had averaged down. Your average will end up being somewhere here, right? Because the whole point is to average down the heaviest at the bottom. And what ends up happening is, again, when we gap down and open outside the lower level of the Bollinger Band, we make a huge run upwards. So now say, for example, your average is 440, even say it's 444, okay? 444 is your average. What ends up happening is by 11:30, we go all the way up to 448. So that's a second example of the most recent January fall where we, have a huge rip to the upside. Now, obviously, right after January 21st is it was January 24th. Now we can go ahead and look at a chart for January 24th. And January 24th was the bottom. All right, this marked the bottom. So again, what you have to understand is when you're trading and we opened outside of the lower level of the Bollinger Band, on a day, like intraday, when we continue falling, that is the most bullish scenario. All right. So again, when we are falling here on January 21st, that is a very bullish scenario. When we are falling very, very heavily and there's no bottom in sight, which was the case on January 24th, there was no bottom in sight. That is the best bullish case scenario, because that essentially, it was the bottom of the market over here, and we haven't retested the bottom until now. So keep that in mind. So essentially what we're going to do is we're going to scale into calls tomorrow. And once again, all right, let me just go ahead and look at this example. So again, say for example, this played out for tomorrow. You buy $200 call here, and then you buy whatever, some more down here, and then we move upwards. You could sell, you know, you'd have averaged in, you could, you know, sell up here, but I, you know, probably wouldn't. But then again, you buy again as we break down below here, and then you buy here. And now, essentially, this is going to be very, very risky for tomorrow. All right, guys, this is not, if you can't stomach losses for tomorrow, do not take these trades. But I'm giving you guys an example of what happens when we open up outside the lower B band and why it's so bullish to scale into calls. And as you can see, on all of these days that we have done that, as you scale into calls on every single drop, you make so much money on the rip upwards, because the market cannot algorithmically be that overextended to the downside. So I'm really, really, really hoping that the market does open this low tomorrow, because it's going to be really easy money in my opinion, because essentially that's what's happened basically every single time we have been doing this. This price action reminded me exactly of the COVID crash, and I made a lot of money during the COVID crash trading it up and down. So yeah, that's basically it. So I hope that made sense. I'm not your financial advisor, this isn't financial advice, but that's going to be the plan for tomorrow.